Hello, everyone. Today, we're going to learn the lesson from the course Development of Digital Currencies. 5.4 Digital Currencies Regulatory System. The rise of digital currencies has reshaped the traditional financial ecosystem. Building a scientific and forward-looking regulatory system is the core path to balancing technological innovation with financial security. This course will systematically analyze digital currencies, regulatory systems, revealing their dual role in safeguarding financial sovereignty and technological ethics. In this lesson, we will mainly cover the following topics. By the end of this lesson, you'll be able to 1. Deconstruct the legal hierarchy and jurisdictional conflicts in digital currencies regulation. 2. Analyze the implementation paths of penetrating regulation in DeFi and DAO governance. 3. Design technical compliance standards that meet quantum security requirements. 4. Plan data sharing frameworks for cross-border regulatory collaboration. First, let's examine the legal framework construction in digital currencies regulation. 1. Judicial confirmation of rights and property recognition. The core conflict lies in the legal dilemmas faced by cross-border disputes over assets like Bitcoin. For instance, the 2023 FTX bankruptcy case involved 1.2 million creditors. Due to differences in digital currencies, ownership recognition between China and the US, China's Civil Code Article 127 defines it as network virtual property, while some states in the US recognize it as currency. The liquidation process stalled for over 18 months. So, how can we solve this problem? Institutional innovations include standardizing legal ownership for private key holders, as seen in Switzerland's Blockchain Act, and establishing transnational digital asset liquidation courts currently being piloted in the EU. 2. Legal validity of smart contracts. Next, let's look at the legal validity of smart contracts. The DAO incident resulted in the theft of $60 million. It exposed the risk of code vulnerabilities without accountability mechanisms. Regulatory responses include mandatory on-chain arbitration. For example, the Ethereum Kleros court system requires arbitrator votes before executing disputed contract forks. 2. Code audit certification. Singapore's Payment Services Act mandates that financial smart contracts must pass 30K security certification. 3. New paradigm for crime governance. Finally, in terms of crime governance, the Tornado Cash Mixer laundered $7 billion in 2022, rendering traditional anti-money laundering systems ineffective. Institutional tools include mandatory on-chain tracing standards. The EU requires exchanges to integrate Chainalysis, and the liability penetration system for DeFi protocols. The EU's funds transfer regulation requires DEXs to fulfill KYC requirements. Next, let's explore the hierarchical structure of regulatory frameworks through 3 aspects. 1. Institutional level regulation. At the institutional level, we need to focus on the collaboration between commercial banks and CBDCs to manage disintermediation risks. China's digital yuan sets personal wallet, limits 100,000 yuan, and tiered interest rates, negative rates, for large amounts. The Bank for International Settlements (BIS) model stipulates that when CBDC penetration exceeds 25%, bank interest margins will require a 50 basis point buffer. 2. Market-level regulation. At the market level, countries have adopted regulatory sandbox practices. The UK monitors Uniswap's liquidity pools, identifying 43% of abnormal trading paths and establishing an automatic circuit breaker mechanism for volatility exceeding plus or minus 30%. Singapore audits Aave protocol reserves, raising the capital adequacy ratio from 78% to 92%, and implementing automatic liquidation rules for collateral ratios below 110%. 3. Technology-level regulation. Technology-level regulation primarily focuses on quantum security and privacy protection. While in terms of anti-quantum migration, the US NIST requires the transition from ECDSA to lattice-based encryption by 2030. China's digital yuan hardware wallets mandate the use of the national SM9 algorithm. 2. For privacy-tiered design, small transactions use blind signature technology for complete anonymity, ensuring basic payment privacy. Large transactions employ zero-knowledge proof technology, enabling controlled traceability only with judicial authorization, balancing regulatory needs with user rights. Now, let's explore 3 aspects of mandatory technical standards. 1. Security Certification System Hardware Standards. India's digital rupee POS terminals must support NFC offline transactions. Key custody. Japan allows banks to manage private keys in case of biometric authentication failure. 2. Carbon footprint constraints. The EU's sustainable finance taxonomy excludes Bitcoin's POW mining from green finance. This has forced Ethereum and others to switch to POS, reducing energy consumption by 99.95%. 3. Age-friendly adaptations. Institutional requirements include designing for 230 million elderly users worldwide. For example, voice wallets. The Brazilian Central Bank's digital currency mandates a 5% offline payment quota. Class. How do international coordination mechanisms address borderless financial risks? Let's continue our exploration. 1. Data sharing networks. The IMF-led Global CBDC Data Exchange Platform 2024 focuses on 3 core areas: real-time monitoring of cross-border CBDC flows, sharing blacklists of mixer protocols, and establishing a quantum computing attack warning database. 2. Standard Mutual Recognition Framework. In terms of standard mutual recognition frameworks, interoperability, protocols like ISO 20022-28 standardize CBDC system architectures. Regulatory arbitrage prevention measures include the EU's requirement that non-Euro CBDC transactions be limited to less than or equal to 1,000 euros per transaction. 3. Crisis Response Alliance. Finally, regarding crisis response alliances, multiple central banks have established joint intervention mechanisms. When sovereign digital currencies exceed 15% of foreign reserves, capital flow controls are triggered. Joint liquidation courts handle cross-border platform bankruptcies, as seen in the FTX case. Today, we've systematically studied the 4 core dimensions of digital currencies regulatory systems: legal framework, construction, hierarchical regulatory frameworks, mandatory technical standards, and international coordination mechanisms. Through this study, we've learned that the core mission of digital currencies regulatory systems is to establish a dynamic equilibrium, among the triangle of technology innovation, sovereign security, citizen rights. Only by constructing institutional infrastructure adapted to the digital finance landscape can we ensure the steady progress of the monetary revolution. Regulatory systems are not shackles that restrain innovation, but guarantees that provide a safe environment for innovation, serving as the cornerstone for the healthy development of the digital financial ecosystem. Finally, please complete the following exercises. That's the end of today's lesson. See you next time.